our entire global economy has been built upon a fossil fuel system. That needs to change. It is an economic imperative, and it's, I would argue, the biggest economic challenge of this generation.
This podcast is for advisor use only and not to be distributed to the public. The Wealth Consulting Group is an SEC registered investment advisor, and the opinions voiced and contents in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that strategies promoted will be successful.
Hello, welcome to the Bull of Wall Street podcast. This is episode number 31. We're super delighted and thrilled to have with us Eli Horton. Eli Horton is the senior portfolio manager with TCW, the TCW Transform Systems, and I believe you also run some other money over there at TCW. Eli, welcome.
Good to be here, Jim. Thanks for having me.
And so I'm going to put my BYU hat on. I don't get to do this very often because you went to BYU. I went to BYU Hawaii, so I know there's some connection there, but you graduated from BYU. I think you did your master's there too?
That's right. You picked well, look, Utah's an amazing place, although Hawaii, I feel like you won the location battle. It was a good 4 years at BYU, studied accounting, sort of stumbled into my career from the accounting program. It's a great training ground. I spent a year in the major and realized that the auditing path wasn't for me. And so I started looking around to see what else was out there and ended up joining the investment banking club and pursuing that trajectory. But BYU was a blast. Loved it.
So but you're in San Francisco now, right?
Correct.
That's kind of where you're based. Okay. You make it to Utah every once in a while?
Yeah, quite a bit. Every year or two, I feel like I'm out there for one thing or another.
Yeah. Do you follow their football? They've had a decent football program, and it looks like they're getting a new, very high recruit. And this is how disconnected I am. He's actually from my backyard. He's actually from Folsom.
That's really cool. So they've got such a long history and tradition of great sports programs. While I was there, the football team was always top 25. I caught the tail end of the Jimmermania days, which were super fun.
Jimmer was fun. Yeah.
They're good again. I think they've got a kid coming in out of Utah, out of a academy in Utah on the basketball team, who I think is the top recruit in the country next year.
Oh yeah. I saw that too. Wow. It's who knows? They may become like a powerhouse school at some point.
Sweet 16 year too. So maybe 2026 is looking all right.
So you started, you said you started off in accounting, you joined an investment banking club, and I saw that you worked for Goldman Sachs doing investment banking. Then it looked like you transitioned to KKR. Tell me a little bit about those experiences and then how you ended up what you're doing now.
I definitely have a bit of a non-traditional background to this. So I grew up in Eureka, California, which you would have heard of being from Folsom. Tiny little town up on the North Coast, single parent family raised me. I had no idea of this Wall Street or finance world as a kid. Ended up at BYU for college. And I went into the accounting program because my mom said, look, there's always jobs for accountants, which I'm not sure that's a great answer for why you go into it. But I said, sure, that's good enough for me. And like I said, I took my first auditing course and said, all right, I don't think this is the right move. But I realized there were other options, and I stumbled into an investment banking club meeting, and one of the kids who was presenting had just spent a summer at Goldman Sachs, and he walked through his whole internship, and I thought it sounded fascinating. And so I started looking into that option and flew myself out to New York a few times. People were kind enough to take me up on a lunch or a coffee meeting and answer my questions. And ultimately I was able to land an internship there. Spent 2 years in their TMT investment banking group, which was just a fantastic training ground and
I
worked with
bet.
incredible people, worked hard, as the rumors are true. You do put in 100-hour weeks, but you get a lot
Wow.
out of it. And from there, I decided that I wanted to be on called the buy side. And I moved over to KKR, spent a few years on the private equity team there. Tech and consumer retail were the industries that I focused on.
Yeah.
And that was down in Menlo Park. So that's when I moved out from New York.
Oh, got it.
Great experience. From there, I wanted to try my hand in the public markets. And so I joined a hedge fund called Maverick Capital, which is a 32-year-old hedge fund, Tiger Cub, with incredible track record. They manage about 50 billion. I spent a lot of my time on industrials for the firm. And that was another very formative experience in building my investment process and working for some great people. And then from there, I left to go help start a couple of ETFs for a firm called Engine Number One. And then TCW acquired that business in late 2023. So I'm coming up on 2 years at TCW.
Wow.
Manage a few strategies for the firm.
That's quite a strategy. I mean, that's quite a journey getting there.
Yeah. Yeah, a little non-traditional, at least in terms of how it started, but I wouldn't change it.
So what you're doing now at TCW, and this is just super fascinated by it because thematically we really buy into this whole idea that, there's a whole bunch of demand for electricity. A lot of that is from AI. There's also a big push to have this electrification and to make utilities more, efficient, but also cleaner. And we don't have enough power. So I'm just super fascinated, when we, looked at your strategy and we've looked at other strategies, it's just interesting how all those kind of fit together. And I would just love for you to kind of tell me what you see big picture and how does this change going down the next 5 years, the next 10 years, because some of the companies now that, maybe they're utility companies, they may not be around, right? I don't know. You tell me, what are your thoughts?
It's such a fascinating topic. So let me sort of back you up a little bit here. When we started talking about this idea 4 years ago or so for the fund that we manage, which is called Powered, PWRD, that it's an energy. It's a thesis around the transformation of the global energy system. And, power, and we'll talk about it. You kind of led with some of the utilities. We'll get into that piece, but that's really one component of it. The world's going through this large scale systems change. And our entire global economy has been built upon a fossil fuel system. That needs to change. It is an economic imperative, and I would argue, the biggest economic challenge of this generation. It's extremely capital intensive. So currently, there's somewhere in the order of $2.5 trillion per year invested to migrate towards a renewable fuel economy, renewable power economy, and to drive down emissions. That's a staggering amount of money. That's annual. It's growing. And so that's a very interesting structural tailwind for the companies that are integral to this transition. So massive change. It's going to take decades. So we've been building out renewables for a few decades, and just looking at the United States, true renewable power generation is less than 20% of total power in this country. We're nowhere near the end of this. And I'm sure you remember just a few years ago, there were targets around reaching net zero emissions in 2050. Those will not be met. I mean, that now I think that's probably well understood. And I think we're now looking at maybe a 2070, 2075 scenario.
Oh, wow.
So we're talking another 50 years of investment here. And so when we got to thinking about this idea, we said, look, this is massive change. It's huge dollars. It's going to last a very, very long time. And we felt like that was a nice setup for stock pickers, which is what we consider ourselves, deep research, to find unique winners. And then we also felt that so many of these companies or what like I'll call old economy businesses, and had just been somewhat neglected by the market and by investors. And we thought that really set up for a compelling investment opportunity. And so we decided to launch strategy behind it. There's a variety of sub themes. I know we'll get into them, whether it's power or, decarbonization of transportation and a variety of other things. But it's a very broad set of businesses that fall within this theme.
Well, and I think it's fascinating because you're not like some of these that I know there's some strategies out there. I'm not knocking any strategies, by the way. We look at all kinds of strategies, but there's some that say it has to have X requirements. And if it's doing anything other than that, get it out. But you guys are different. You're saying how they're set up, what they're doing, and where they're going is actually more important than like where they are today. Some of those companies, by the way, that are saying, hey, we can do this today, some of them may not be profitable. Mm-hmm. Some of them, are only kind of there because they're taking in a lot of federal money, right? So there's that component. And then there's just, I guess, for me, what's fascinating and just perplexing is like we have all these resources, but storing them and processing it, like you said, all the money, all the capital expenditures that are there to make things work, it doesn't seem to be that efficient. And I just read the other day that, it's kind of in your neck of the woods in Benicia. They have, I think it's Valero has a couple of refinery plants that they're saying they're just going to shut them down. There's one, I think, in Southern California. And so they're saying California might have $8 gas. So that was the headline. I don't know if we're going to get there, but like, it makes you think that, wow, like we haven't really added any refineries. I mean, we're starting, I think, to talk more about nuclear. We have natural gas that it's still fossil, but it's a lot cleaner than coal and oil. So what do you think of all this? I mean, where do we go?
There's a lot of interesting things in there to unpack. So just on the refining comment, you made me realize or think of the point. We have neglected to invest in the capital and industrial infrastructure and the energy infrastructure in this country. We hear it a lot with, take the Infrastructure Investment and Jobs Act, which is meant to invest in a variety of infrastructure in this country, roads, bridges. So I think that's probably topical, that folks can see physical infrastructure like that is in need of investment. Same for the industrial economy. So last time I pulled this stat was a little over a year ago, I think, but at the time, CapEx to sales ratios were at 20-year lows. That's chronic cyclical underinvestment. I think it's easy to understand why that happened. We went through a financial crisis about 16, 17 years ago.
Yeah.
And businesses had to get their balance sheets in order, and a premium has been placed on companies that buy back stock, and buybacks are basically at all-time highs. And so that capital has gone to buybacks instead of CapEx. And much of that has come at the expense of the industrial and manufacturing and energy infrastructure base in this country. So now we're at this weird collision, this ugly collision, where you've got chronic cyclical investment coming through and colliding with structural forces like rebuilding the grid and adding to our energy infrastructure and investing in the energy transformation and bringing manufacturing back to this country. That sets up for an entirely different next 20 years for a lot of these old economy businesses who receive this capital compared to the past couple of decades where they were being starved of capital. It's a complete paradigm shift.
Wow. Well, let's talk a little bit about some of the names in your portfolio. I know you've got some technology names in there. You have some of the traditional, older companies that are in there. You got some industrials. You have some utilities. I think you have like waste management type companies in there, right? So how do they all fit together? And when you're looking at these things and you're trying to say, well, what is what's my conviction and what's long-term, what's short-term, and then throw in AI with all of that. How do you put together the portfolio, and how do you adjust it over time?
So when we started out mapping out the opportunity set for this fund and this thesis, we immediately started to gravitate towards going where the emissions are and looking at the dirty companies.
Sure.
The brown companies, the old economy companies. You kind of hit this earlier. And I think especially when we started the strategy about a little less than 4 years ago, we were very different in our perspective then. And most energy transition strategies said, go to the green companies. Our pushback and where I struggle with that has always been, we have to have businesses that have unit economics that can stand on their own 2 feet without government support. And a lot of the green technology type of businesses that were trading in the public markets didn't offer that very critical fact, very critical condition.
Yeah.
And the ones that did oftentimes didn't have valuations that made sense. I haven't looked at it in a few months, but there's a S&P clean or S&P energy transition index, I believe. And I believe it launched in 2004. And you can pull this up, but the market's up, several hundred, probably 700% or something since then. And this clean energy index is up maybe 15.
Wow.
Yeah, it's like staggering. The performance delta between the two. And it's because the companies didn't succeed. And so we felt that going where the emissions are, going toward the old economy companies that had scale, that were investing to decarbonize, that's where the value would be created. So that's where we started. If you look at the different types of opportunities to invest here, we immediately looked at power and grid, energy infrastructure, transportation is a huge area of opportunity, EVs, commercial freight, aerospace, the agriculture economy. It's very, very broad, so it's not just energy.
Yeah. That's super fascinating. And then how does AI fit in all this? I mean, I read somewhere that I think it's Meta has this this co-op, or maybe they own it, but down in Arizona, there's they're generating some power and then they're giving it back to Phoenix or areas around there. Do you think that some of these very large companies that are very, very hungry for electricity, they need, the demand for electricity is just off the charts, are they going to be quasi utility companies at some point?
I don't know if they'll be utilities. I'm not sure that they should do that with their business model, but I do know that they are driving even more demand for electricity. So let's try to unpack this topic in a bunch of different ways. So last 20 years, electricity demand in the US basically flat, like 2000 and 2020, almost no growth. We shipped manufacturing overseas. We got a little bit more efficient with electricity waste. And so that led to a flat electricity demand environment. Most estimates would point to something like 3% annual growth for electricity from 2020 to 2050.
Yeah.
That doesn't sound like a big number, but when you compound that for the next 30 years, that's a doubling of electricity demand.
Wow.
That is going to result in a massive investment to the supply side, the grid, not just a doubling, but potentially a tripling, because we're bringing on a lot of intermittent electricity generation through wind and solar. So you have to have more latent capacity. Back to your question on AI.
Yeah.
So what's driving this 3% growth per year? A variety of things. So we're electrifying transportation, EVs, we're electrifying buildings, our entire economy. We're bringing manufacturing back to the US. I think every 1 point reduction in imports is something like 10% electricity demand. So those are three sort of industrial structural drivers that already existed. And then we toss in AI with these hyperscale data centers and insatiable demand for compute. And that's adding up to another point of electricity demand annually. from these massive gigawatt scale data centers that folks like Meta are building. And so I'd say sometimes like the fire was sort of already there, and then AI came along and poured gasoline all over it. So,
wow. So it was 3% before, and now it's probably more likely 4%.
I'd say it was 2, and now closer to 3.
It was 2. Oh, got it.
Yeah.
And then does that change though? Like, as more people buy electric cars, or is that already factoring that in?
That's a current number.
That's a current number. So if more people buy electric cars, and I know Jimmy Lee, he couldn't make it to this podcast, but he's talked about buying a robot. So sure. More people buy robots, things like that. That's electricity and powering all these things. How about, do you guys think much about like the storage and transfer of electricity? Because that seems to be one of the challenges, right? Is how do you store it? I mean, you could have like a whole bunch of, I think you probably, I'm sure, seen those things on social media. Like if the whole state of Rhode Island had solar, then it could power like, like how many states? But like the reality is like you can't store it, and transferring it's difficult. What do you guys think?
This is a problem. It's a huge problem.
Yeah.
So we all want clean energy, but we have a 24/7 economy. We can't have power that's not 24/7. And you can do it with wind and solar if you just add loads of it to the grid to cover, during peak hours. But you need some battery storage as well. And that's sort of your question. And the battery supply chain is, it's a bit of a mess, like most supply chains. And so right now we're not able to produce all the batteries, and we don't have all the critical minerals available to meet the demand just through wind and solar. So it's just less efficient. It's too expensive right now. So you can't add enough power to the grid with those sources. So what are you seeing? We're seeing a nuclear renaissance. Full stop. We should talk about that. We also think that natural gas is a very, very important transition fuel source. It emits carbon. It's dirty, but it's certainly a lot better than coal. And we're not going to build new coal plants. But unfortunately, coal plants are running longer, and their useful lives are being extended because we have this surge in electricity demand, and we can't meet the supply quick enough.
That's incredible to think that we're still burning coal. I feel like we should have probably moved way beyond that, but it's because of demand, right? We have to.
Completely. There was a piece in the Wall Street Journal about this today, and it was focused on the executive orders that have come out of the administration around nuclear, but it gave some stats on coal, which is still, to your point, a very, very meaningful portion of power generation, electricity generation in this country. Nuclear, though, is fascinating. So in this country, there's 94 large-scale nuclear reactors. We've built, I believe, 3 of them since 2000. We built a couple in Georgia. The last one finished construction last year, but there's no others in construction. And so most of these were built from the 70s through 1990 or so.
Sure.
And then we just stopped because they're very expensive. They're complicated. There was obviously some concerns around things like 3 Mile Island.
Safety.
Totally. But nuclear is carbon free. It's actually been generally extremely safe. The incidents are very headline grabbing, but it's been extremely safe, and it's gotten safer. And so we're seeing nuclear be in very high demand. Companies like Meta and Amazon and Microsoft are buying up nuclear power assets, and they're paying premiums for it. So, in the past, nuclear power has gone for $45 a megawatt hour. Now we're seeing it go for double that. Companies that own these assets capture that price straight to the bottom line.
Wow.
Some of these utility companies.
That's incredible.
And we own a few of them. So that's a complete paradigm shift just because of power scarcity.
And what do you think of these smaller modular reactors that are coming out? I know we own Oklo, and I don't know if it's pronounced Oklo or Oklo, but that's interesting. And some of these other, innovations that are out there. What do you think of all those?
Well, good for you. That's been a good stock. Great stock. So, look, I think SMRs will happen.
Mm-hmm.
The most kind of near-term estimates, if you will, for commercialization and deployment of SMRs is around 2030 now. Historically, we've been a little bit optimistic on the timeline for SMRs and for most of the time with new technologies. So I'm somewhat skeptical that it'll happen by then, but it will happen.
Sure.
The challenge is I don't think they can move the needle enough on their own. So an SMR is 300 megawatts of capacity or less typically. And a large scale reactor is like call it a gigawatt.
Mm-hmm.
We need, just for AI, we probably need 75 gigawatts of new capacity by the end of the decade.
Wow.
That's like 7 times the size of New York. That's more than that. That's 15 times the size of New York City.
That's crazy to think
It's
about
shocking,
that.
right? Yeah. I mean, think about that. Like adding enough to the grid for 12 to 15 New York cities. Think about all the physical infrastructure that's required to do that, the turbines, the copper, all the electrical equipment, the concrete and cement. I mean, that's a lot. So I don't know how we do that, first of all. But I think it'd be very hard to do this with just SMR. So
yeah,
I think we'll need a variety of solutions. Large scale would be a good one, certainly nat gas. On the large scale piece, so the governor of New York, you probably saw this last week, came out and said that she wants to see a new large scale plant built in the state of New York, which is quite a stunning reversal.
Wow.
How they've historically talked about this.
Yeah. That's incredible. So it sounds like it's really a combination, like all of the above, except for maybe coal. Right, coal.
Kind of needs to be all hands on deck. I think that's right. I think that's exactly right. And coal. Look, that's not where we want to go. That would be a big step backwards.
Now, are there areas where you look at it and say, well, it's not super efficient, but we need to do it anyway? Like, is wind like one of those areas that it kind of helps, but it's not as efficient as solar? And so where do you kind of look at this and say, you really should just be focusing on this group of, assets that would produce electricity?
We would like to see the cost of constructing and installing solar plus storage come down, and it will.
Yeah,
that would be the best thing for us. That type of power generation costs very, very little to run. It just costs a lot to build. The challenge is it takes up a large area of space. You have these massive solar farms to generate only a certain amount of power. So that's certainly an issue, but I think that is probably the leader in the clubhouse right now for where we need to go on the renewable side, and then nuclear.
Yeah. And then keep using natural gas for as long as we can.
Right.
If it's not oil or coal, the nat gas, there's plenty of it. It's cheap, and it's interesting.
So you can build a new nat gas power plant in a year, maybe a little over. And especially if we improve with permitting reform and regulatory reform, that should get better. And so that can allow us to have, to manage the transition. Nuclear takes a lot longer, call it 5 years at least for large scale, maybe a little bit more. So I think nat gas is a transition fuel source. The commodity nat gas is readily abundant in the U.S., so we're fortunate in that regard. And it can help us build more, transition to build more nuclear and more solar.
Yeah. Now, how about the rare earths? Or is that something that we're ever going to have our own, be able to mine our own, or is it just like not something that we want to do, or are we going to be beholden to China or Canada for that?
So from what I understand, and I don't think I'm an expert on this, but from what I understand, we actually have most of the rare earths available in North America. We just don't have the value chain and supply chain to extract and refine and produce them. but I
Yeah.
believe that we have most of them in the ground. So that would probably take many years to build up a
Build that
effective
out.
and productive commercial supply chain. But I believe we have the commodities for the most
Interesting.
part. Yeah.
So do you think we're going to keep relying on China until we get there to where we can be completely independent, or?
Well, that's interesting. I mean, that's kind of what I feel like is being thought through at very high levels running this country along a variety of dimensions: energy security,
Sure.
ships and chips, right? So
Oh yeah.
shipbuilding and chip manufacturing.
Yeah.
We used to manufacture the majority of the world's semiconductors, and now
Yeah.
I don't know, we're 10% or something.
Yeah.
And that's obviously a strategic imperative and something for national security that is very high in priority. I think we keep finding these vulnerabilities that we have either created through globalization or what have you, but it does seem that something like rare earths would fall on that list, right?
Yeah. How about quantum? Have you looked at quantum much or thought much about it? I mean, I know it seems kind of out there, but like to the degree that it can solve some of the challenges with a lot less energy than AI, maybe that helps a little bit off, taking off some of the demand, or is that just going to take too long to get there? What do you think?
So we haven't looked at the quantum companies themselves. There's not a lot of them in the public markets, and most of them just don't really fit the profile of the type of business that we would want to own. But what I can't believe I'm about to use the Jevons paradox term. It's said too much, but we do believe though that when the cost of a good falls, that drives up demand for the good, and if it's compute, I think that drives up demand for the compute. We saw some of this earlier this year being tossed around with DeepSeek Monday. And what we prefer to do is own the proverbial picks and shovels, if you will. And so in this case, much of it would fall back to that, power producer, electric grid ecosystem value chain that will really serve the entire compute industry, if you will. I mean, it's the literal foundation of what they're building, and we can see that that's like the source of scarcity in the market. You can see it in the data center market, that power is really driving where these go. So that's how we are, participating in a quantum, I suppose. Although it's probably not moving any of the stocks we own at this day and age.
Interesting. How about the companies that are? I'm just thinking of a particular holding that we have that is like an air conditioning HVAC for data centers, and
100%.
They've got so much demand that, and their margins, by the way, are through the roof because they have to keep these huge data centers cool, and they're building more of them. And so it seems like a great business to be in.
So I don't know who you own, but we've owned Trend for quite a while, and you can see what we own because it's an ETF.
Okay.
We've owned that stock for a long time. I felt like we got an opportunity in it in the spring of 23 when we had the regional banking crisis, and so SVB and with First Republic, right?
Got it.
That catalyzed the market to become extremely concerned about commercial construction, lending would dry up, et cetera. And a variety of companies got sold, and so did the HVAC businesses. And we felt like that was throwing the baby out with the bathwater. If you look at commercial HVAC, it's 90% of the revenues come from service, 10% from new sales. So, and of that 10%, how much of it was like small commercial construction? I don't know. A portion, half less. So we were like, okay, great. The new business might be a little soft, but what really drives the bus is this service business.
Sure.
And if your HVAC goes out, you are going to fix it. Full stop. You're not going to defer that, especially
You're not going to think about it, and you're not going to shop around. You're just going to fix it, right? I mean,
100%.
especially if you've got a data center out in Arizona, I can only imagine like it's
100%.
hot.
You can't have that go down, or else the data center isn't going to work, and chips are going to deteriorate. That's a problem.
Yeah, that's interesting. So we own Comfort System. Comfort Systems is worked out for us.
Amazing. Yep.
Interesting.
So look, we thought these were very durable companies, and then to your point on data centers, we're seeing data center construction explode.
Yeah.
And the data centers to begin with throw off a ton of heat. Now you throw in an NVIDIA GPU for a CPU instead, and a rack of servers is having materially more power consumption, but also heat emission. And that's creating a variety of issues. So historically, you blow cold air in one side of the building and hot air out the back. Great. But now we're seeing emerging technologies like liquid cooling, which a couple of companies we own are involved in that space, where you're basically cooling direct to the chip and direct to the server rack. So that's another interesting angle of these data centers. But yeah, HVAC really fits this area nicely. And they're also a big source of electricity consumption inside of buildings, and they're trying to get more efficient there. So there's a variety of ways that they fit into this energy transition.
Super fast. I feel like you and I could talk about this for a long, long time. Well, I mean, we're kind of getting close to the top of the hour here. As you think about what are the other areas that we need to do, and I don't want to be political, so it doesn't really matter who's sitting in the White House, but like, what are the areas where the government needs to, they either need to spend the money or they need to partner with private to spend the money to say, hey, we need to get caught up, whether that's refinery or transport of natural gas or the roads. I mean, or like rail. I don't know that's been around a long time. What do you think are the biggest areas where we just need to improve?
Deregulation, full stop, and permitting.
Wow.
And so I had this conversation last week. I was sitting in the office of one of our investors, and he works for a national firm and runs his wealth business for them. And he was explaining how he had moved from a very, very large firm to kind of a medium-sized firm. And he was explaining the differences. And what he said is, it's just so much easier to do business. If I want to do something, take some action to like grow with certain clients or whatever, I don't have to go to committee, rules. And he was explaining how easy that was and how it helped him make the switch. And I thought about that with our country and how we're seeing so much industrial investment happening in red states. Let's just be honest, in Texas, and the Southeast.
Yeah.
And if you take the grid, so there's this concept called interconnection. It's basically attaching power generation to the grid.
Yeah.
Nationally, I believe we're at about a 5-year backlog. That's because of permitting and regulation. In Texas, I think it's closer to 2. California, I think, is closer to 7.
Wow.
So good for us, Jim. We're leading. We're leading.
Backlog. So what does that mean? It means that like 5 years, 7 years in California, they're finally going to get stuff approved that people have been waiting on. Wow.
Yeah.
That's crazy.
And we think how much that holds back economic productivity.
Well, and I just worry about the companies that they want to put their own skin in the game. They want to invest, but then they're like, I don't know about the environment. I'm just not going to do it. So then discouraged investment means no investment, right?
Right. And then you end up in this, since we're talking about power, you end up with power price surges, and whose pocket does that come out? So that's a problem. The executive orders, which the White House released a few of them a few weeks ago, they did highlight the imperative of permitting reform for nuclear. We've seen a general mindset towards reducing or speeding up permitting for very large scale manufacturing projects, which we're seeing a ton of that in the U.S. now. We're seeing over $2 trillion in the last 4 years. That's a lot. And big things. I mean, we saw Hyundai Motors come out with a very large one last week. GE's moving their appliance manufacturing back to the US. So we're seeing big projects, and I think a lot of these will come with improvements in permitting, but that would be a very, very valuable thing for our economy to unlock growth. And from a fiscal perspective, we obviously need growth to improve our balance sheet. But that would be, I think, the best thing the government can do.
Wow. Well, do you think because you have a goal that's to be net zero, but then you have a goal to be efficient? I mean, I feel like that should be bipartisan, that like it shouldn't be political. Do you think we ever get to that point, or is it always going to just be political?
That'd be nice, wouldn't it? I don't know if I'm that hopeful. I think, what I think is bipartisan, though, is bringing manufacturing back to the U.S.
Okay.
I think that's very clearly bipartisan. We've seen support for that. You certainly saw it in the Biden administration with the CHIPS Act, IRA.
Sure.
Obviously, the Trump administration is very pro-manufacturing in the U.S. He goes about it differently, but he obviously is pushing for it. I think that's across the aisle. Now, on the energy side, I think it gets much more tricky because of the source of where that power comes from.
Got it. Yeah.
So I think that's the challenge there that creates roadblocks, which, by the way, goes back to the very beginning of our conversation where I just said how complicated this transition is. Like, it's complicated on its own when you think about the technology and the capital investment and the scale across the value chain, but then you lob in, the challenges and the constant changing of the winds inside of our administration or even globally, that makes it more complex. Highlights how long this theme goes.
I'm sorry, what was that?
It highlights how long this theme will last.
Oh yeah. How about the theme of us exporting liquefied natural gas? I mean, we were doing that to Europe. I think we're still doing that. I'm thinking of like Cheniere was kind of doing that. Does that continue, or are they going to have other supplies? I can't imagine the Europeans going back to Russia and saying, okay, we'll buy from you again. So curious how that works, because we have ample supply of it.
This is fascinating. So on so many levels, global supply chains for everything tend to be very complex. And every time you add another node, that increases the complexity exponentially, not linearly.
Yeah.
And we tend to think about manufactured goods, but commodities have global supply chains too.
Sure.
And much of Europe, especially Germany, was very dependent on Russian natural gas.
Mm-hmm.
That obviously got cut off a few years back. You could see net gas prices went vertical. And the U.S. is blessed to sit on abundant natural gas, and so we're exporting it through liquefied natural gas, companies like Cheniere. This ties into nuclear too. So if you look at France, they've actually done the nicest job of creating energy independence, and I believe it's over 2/3, I want to say, of their power production comes from nuclear.
Wow.
So they rely very little on fossil fuels. Nuclear is by far the largest for them, and then it's renewables, and very little on fossil fuels, i.e. natural gas, that are subject to whatever national security risk or global tensions, geopolitical tensions, things like that. So that's another case to be made for energy independence, security, and potentially nuclear.
Well, this has been so wonderful speaking with you, Eli. I don't think I have any other questions. Normally I have a few other guests and they have like a lot of other questions, but we've covered a lot of territory today, and we're super, super grateful to have you.
Hers and his, Three's company too. Come and dance on our floor.